But let's welcome on board then our two guests for the evening. We've got Jimit Modi of Samco Securities and Barclays. William Hobbs joins in as well. Gentlemen, both of you, thanks so much for taking time out for us. Jimit, first, let's talk about our markets and how are you positioned right now? You know, how would you describe your stance? Is it neutral, positive or even somewhat negative?
As far as our position on the market is concerned, we are on an avoid position. So we are not creating any fresh longs as far as trading positions are concerned, and neither are we allocating fresh capital into investments. So currently the call on the market is essentially an avoid. We spoke earlier last month. At that time, we had a fairly buy on dips call, but at current levels of the indices, we are not too comfortable building longs, and also I think there is no indication of any major correction happening. So there is no indication to even go short on the market. So it's an avoid call on the market, and as far as trading positions are concerned, it's time to trail the longs.
Jimit, let's talk about specifics. I remember when you were on the show earlier, pharma was where you had started nibbling in. That was the worst point in the pharma space, and there has been good 10, 15%, 20% in certain cases, the rally from there. That was a contra bet which panned out for you. What's the next contra call on your mind right now?
So, we are mildly bullish on IT at the moment, because a lot of the concerns with regards to lack of growth have been priced in. Practically for the past couple of years, the sector seems to have done nothing, and at the moment that's the only one of the few sectors which actually offers any margin of safety at the current levels of the indices. We are not actually comfortable building fresh positions in any other sector, purely because of certain excesses that have gotten built over the past few months because of this rally.
William, what's your strategy from here on? The US Fed Reserve clearly delaying the rate hike in order to increase, in order to give some boost to the economy. Do you think that will give more room or cushion on the macro side? And should one presume that one hike in 2016 is inevitable now, and hence probably getting in the price as well?
Well, nothing is inevitable. I think that's the first thing to point out. But certainly from the sort of Fed communication, it did feel like there was still very much, another rate hike on the horizon within for this year. I think that sort of a lot is going to depend on the data between now and then. Interestingly, it's going to be sort of the end of this week, end of next week. The PCE core PCE data will show sort of CPI and PCE have been telling us different things, so we'll see whether PCE is starting to pick up. And certainly if we look at the wider economy, the labour market looks tight and getting tighter, and wages are starting to pick up. And all that sort of suggests that the Fed should be thinking about raising rates. Whether they do or don't, that's going to be up to them.
Well, even as Janet Yellen very categorically in her press conference said that partisan politics plays no role in the Fed's decision making, how crucial would you say is the outcome of the presidential election for monetary policy in America?
Well, it's going to be interesting. It's going to be interesting to see how markets react. Now, for us, most of the time, what you tend to say about sort of political events and markets, and Brexit is probably quite a good example of this, is that there's no sort of long-term impact generally from politics, from general elections, from these kind of things. And in this situation, we would be wary of sort of exaggerating the power of the President of the United States. If you see him or her portrayed in films, they can battle off alien invasion single-handedly, so on and so on. But in reality, they're very much constrained by Congress. Presidents, to get stuff done, have to work closely with Congress. And that suggests that, to us anyway, that markets will probably, or that the interest rate outlook shouldn't be materially affected by the presidential elections.
Jimmy, let's talk about our markets, and how do you see the script of the market, playing out over the next 6 months or so? And I'm also saying that because the US presidential elections is a big event that's coming right up in the next, month and a half.
it's going to be a sideways market. I think at least till the US elections, we are not going to have a massive movement in the market on either side, and we are braced for a good times correction. I think a couple of months of sideways movement in the 8600 to 8900 band will do the market no harm, and I think will actually make the market more healthy for the next leg of the up move. And I think on the other front, even the primary market has started to pick up.
Jimit, what exactly are your overweights and underweights right now? What's the hypothesis that you are making, because 8600 to 8900 is a very narrow range for the markets?
So as we discussed earlier, our overweight call currently for fresh investments remains on the IT and the pharma space, because that's the only sectors where we find that there is some margin of safety available from an investment perspective, and valuations are attractive for the next 2 to 3 year investment horizon. As far as an underweight is concerned, we are underweight on the BFSI sector, and as a sector as a whole, private banks and public sector banks seem to be priced to perfection. People seem to have discounted the fact that probably the NPA crisis is behind us, while we are of the view that that's still not the case, and we may still see some pressure as far as the NPAs are concerned. And also, I think credit growth and offtake is still a good 6 to 8 months away. And having said that, valuations at current level don't excite us too much, and therefore our underweight call on the BFSI sector.
Jimit, lastly, leave us with your views on what kind of risks we should be cognizant of in the market right now.
Clearly, Donald Trump is one of the biggest risks in the market at the moment. I think markets would get really, really nervous if Donald Trump was actually to get elected as the US president. And we believe that because of the impending US elections, we're likely to be in a sideways market, and markets are going to wait for an outcome for what happens in the elections. Until then, we're going to have a very, very tight range bound move.
Okay, Will, outside of Donald Trump, what are the other risks that exist to this liquidity driven rally that we've seen for markets like us? For one, do you suspect that it could reverse once we see the Fed actually tighten rates?
Well, it depends how quickly, really, and it's a good point. Certainly, the emerging market assets generally have done well as the kind of dollar has softened this year, and the sort of Fed rate expectations have sort of softened a little bit. That path has been lowered by the market anyway, and certainly you've seen bond yields go down, yield curves flatten around the world, and that's been helpful. However, we'd be wary of just saying that it's been solely the weak dollar or the sort of softer tone to monetary policy that's behind EM assets doing so well this year. One of the things is also the bounce in commodity prices, but also actually you're seeing a turn, certainly within the Asia business cycle, you're seeing a little bit of a bottoming out, a cyclical bottoming. And ex-China, where that slowdown will progress, we suspect that things are actually, the prospects, cyclical prospects are actually improving a little bit in EM in emerging markets, particularly in Asia, and that to us suggests that you don't want to sort of just panic sell as soon as the dollar starts to appreciate or interest rates go up. That would probably miss the wider picture for us.
And last but not the least, this is an important question, Will. What's happening to oil, and the fact that Saudi Arabia, ahead of that OPEC meeting that kicks off on Monday, has offered to reduce oil output if Iran agrees to supply, to freeze its supply. Unlikely though, don't you think, that we'll actually see that happen?
For us, we're looking more at the sort of market dynamics, I guess, and one of the things that you would point out with regards to the oil market is that you've seen about a 40% cut in capital expenditure globally on the figures that we get since oil prices peaked in 2014. And at some stage, even with all the sort of incredible and dramatic technological improvements in getting the stuff out of the ground and taking it to market, that still suggests that for an industry that has to run pretty hard in capital expenditure terms just to stand still to offset those kind of depleting assets, that suggests that oil prices probably over on a 1 to 2 year view do trend upwards from here. But in the short term, it still feels like there's a little bit of more indigestion to get through, and we wouldn't probably want to lean on an OPEC agreement of any sort to send oil prices higher. That doesn't feel particularly plausible.
All right, gentlemen, William and Jimit, both of you, thank you so much for taking time for us and walking us through your market strategies. Let's move on and talk about the big story here. Big regulatory changes in the offing for real estate and infrastructure investment trusts. The SEBI board today has given REITs to go ahead and invest in SPVs through holding